When we look at what today's Iraqi dinar data actually shows, the first and most important point is that the story is far more about stability and management than about sudden movement. The official exchange rate remains set at 4,300 Iraqi dinars per US dollar, and this rate continues to be used as the benchmark for government budgets, public sector salaries, and official financial planning. That fact alone tells us that Iraqi authorities are prioritizing predictability in their monetary framework. At the same time, parallel market rates have continued to trade above the official level, often fluctuating in a range roughly between 420 and 1480 IQD per dollar, depending on dollar availability and enforcement conditions. This spread is not new and it is not being ignored. Instead, it reflects ongoing pressure points within the system, particularly demand for hard currency, trade settlement friction, and compliance tightening in the banking sector. From a data perspective, the key takeaway is not the existence of the gap itself, but the fact that the official rate has remained unchanged despite it. That consistency signals policy intent. Iraq is choosing to manage pressures through regulatory tools and liquidity controls, rather than redefining the exchange rate. Investors watch this closely because currencies that maintain a stable official anchor during periods of stress are often being actively defended by reserves and institutional discipline. Iraq's oil exports, which typically exceed 3 million barrels per day, continue to generate substantial dollar inflows, supporting foreign currency reserves and reinforcing the ability to maintain the current framework. Inflation data also plays a role in this picture. By holding the official rate steady, authorities limit the pass-through of currency pressure into import prices and consumer costs, helping keep inflation within manageable ranges. Taken together, today's data shows a currency system under pressure, but not under loss of control. The numbers point to deliberate management rather than panic, and to a strategy focused on maintaining stability while addressing underlying distortions over time, not reacting to short-term market noise. Another layer of what today's Iraqi dinar data shows is how liquidity management and dollar access are shaping day-to-day market behavior without altering the core policy framework. Dollar demand inside Iraq remains elevated, driven by imports, travel, and precautionary behavior during periods of regional and global uncertainty. This demand is visible in the parallel market, where rates continue to price above the official 1,300 IQD USD benchmark. However, data from banking activity and policy actions indicates that authorities are responding through process adjustments rather than price changes. Measures such as tighter documentation for international transfers, closer monitoring of import invoices, and channeling dollar access through regulated banks are designed to reduce informal demand and bring transactions back into official systems. From a data standpoint, this explains why parallel rates can fluctuate in the mid-1400s IQD per dollar range while the official rate remains fixed. The divergence reflects friction during enforcement and adjustment, not abandonment of policy. Investors interpret this as a sign that Iraq is attempting to correct behavior at the system level, how dollars are requested, approved, and used, rather than absorbing pressure by weakening the currency. Another important data point is the continued capacity of the central bank to supply dollars through official channels, supported by ongoing oil revenues and reserve buffers. As long as oil export receipts continue flowing and reserves remain sufficient to cover imports and obligations, the official rate can be maintained even when market sentiment is uneven. Inflation indicators reinforce this approach. Allowing the official rate to slip would immediately raise import costs and fuel price pressures, while managing liquidity preserves price stability. Today's data therefore points to a managed adjustment phase, where authorities are willing to tolerate short-term market spreads in order to protect longer-term stability. For investors, this confirms that Iraq's currency strategy remains anchored in control, sequencing, and institutional discipline rather than reactive market pricing. Another significant insight revealed by the current Iraqi dinar data analyzed today is the continued close relationship between the balance of external accounts and oil revenue, flows as crucial underpinnings of currency stability. Iraq's economy remains largely dependent on the support of substantial oil exports, which consistently maintain an above-average daily average of around 3 million barrels, providing a steady and reliable stream of U.S. dollar inflows into government accounts. This consistent inflow directly bolsters foreign currency reserves and enables the central bank to adequately meet the growing demand for dollars without fear of significantly altering the official exchange rate. This critical data point is important because it directly supports and strengthens currency reserves, enabling the central bank to rely on a sufficient reserve position and maintain confidence in the ability to manage both the official rate and dollar demand in the private sector without being exposed to sudden, disruptive policy shifts. Investors closely monitor the relationship between these elements because currencies with a strong foundation of predictable external earnings tend to be less vulnerable to unpredictable shifts in monetary policies. This data analysis clearly demonstrates that, despite turbulent market noise, Iraq's reserve position remains sufficient, allowing for ample protection during extended periods of higher imports. To ensure the sustainability of the 1300 IQD USD currency framework, another crucial factor that investors consistently closely monitor is how oil revenue is effectively converted into liquidity in the domestic Iraqi economy. The authorities in Iraq appear determined to maintain a stable official exchange rate without allowing fluctuating oil revenue streams to directly feed into currency movements, resulting in a more smoother flow of revenues and budget execution. This approach ultimately helps minimize the risk of pro-cyclical currency behavior that might arise from the inevitable impact of a sudden shift in oil price trends, which might force an immediate devaluation of the currency. By actively managing the official rate across different oil price environments, Iraq effectively signals, not surprisingly, that its currency policy remains anchored firmly to its energy fundamentals but is managed carefully, without being controlled purely on a day-to-day basis. For investors, this balanced system, characterized by robust external earnings, combined with disciplined monetary response, suggests the existence of a resilient currency strategy rather than a fragile one, reinforcing the view that Iraq's currency management approach is indeed being driven by a long-term, comprehensive and sustainable vision rather than short-term, reactionary tactics. A fourth point that today's Iraqi Dinar data highlights is the role of policy consistency and institutional behavior in shaping market expectations. When investors analyze currency data, they look beyond daily price movements and focus on whether institutions respond predictably to pressure. In Iraq's case, recent data shows that despite fluctuations in parallel market rates, official policy signals have remained steady. There has been no indication of abrupt shifts in exchange rate, assumptions used for fiscal planning, banking regulation, or government spending. This consistency matters because markets tend to penalize uncertainty more than weakness. A currency system that responds erratically to pressure invites speculation, while one that responds with measured, repeatable actions builds credibility over time. Today's data suggests that Iraqi authorities are choosing the latter path. Another element investors notice is how banking behavior is gradually adjusting within this framework. Data from transaction flows and regulatory actions points to a continued effort to move dollar activity into formal channels, even if that process temporarily slows trade or raises costs in the short term. From a market perspective, this is a sign of structural adjustment rather than breakdown. Currencies become more stable when informal and opaque flows are reduced. Even if that transition creates friction, investors often expect this phase to be uncomfortable, but they view it as necessary. The persistence of these adjustments, rather than their immediate success, is what sends a signal. It indicates commitment. Today's data also reflects an awareness of expectation management. Authorities appear cautious about fueling optimism or panic through communication. Instead, messaging has remained focused on regulation, compliance, and gradual normalization. This reduces the risk of self-reinforcing cycles where expectations alone drive currency pressure. For investors, expectation control is a measurable input into risk assessment. When policy actions and communication remain aligned, markets are less likely to overreact to short-term data points. Taken together, this part of the data reinforces the idea that Iraq's currency environment is being managed through institutions rather than emotion. While challenges remain, the pattern that emerges is one of deliberate control. For investors, that pattern matters more than any single rate print. It suggests a system that is learning to absorb pressure without losing direction, which is often the clearest signal of durability in emerging market currencies. The final picture that emerges from the current data analysis of Iraqi dinar is one that emphasizes progression rather than destination, and this crucial distinction is vital for comprehending what the figures genuinely imply. The data does not lead to any sudden changes or drastic shifts, but it does uncover a clear and strategic approach centered on direction and resilience. The official exchange rate remains steady at 1 to 300 EQD per US dollar, while the parallel market pricing continues to express the short to long-term demand pressure. This harmony illustrates that authorities are allowing the market to express stress without allowing that stress to redefine their policy stance. In the realm of currency analysis, this can frequently symbolize confidence rather than denial. Another fundamental observation that the data delivers is how it illustrates risk prioritization among Iraqi policymakers. These individuals appear to be more focused on preserving price stability, ensuring consumer power protection, and balancing the budget, rather than immediately reducing the spread between the official and parallel market rates. From the perspective of an investor, this approach is a rational choice. Closing the exchange rate gap too swiftly by devaluing could potentially generate inflationary pressure, increase import costs, and jeopardize social stability. Today's data reveals that authorities are deliberately adopting a short-term approach to minimize long-term damage. Investors tend to be attracted to this trade-off, particularly in environments where stability supports broader reforms. Moreover, the data further underscores the critical role of capacity-backed policies in the success of Iraq's exchange rate framework. Iraq's ability to sustain its exchange rate structure relies heavily on oil revenues, buffer reserves, and prudent fiscal planning. Present indicators suggest that these reinforcements remain in place, enabling policymakers to maintain their chosen path. As long as external resources continue and funds are managed responsibly, the official rate remains believable, even when market sentiments fluctuate. Investors closely monitor this equilibrium because it ultimately determines whether policy choices are sustainable or vulnerable over time. In conclusion, what today's Iraqi dinar data presents is a dynamic system still in transition rather than in crisis. The figures consistently mirror ongoing adjustments, not loss of control. With respect to investors, this critical distinction is of immense importance. The currency credibility is not achieved through a perfect match between official and market rates, rather through consistent and resilient policy behavior to adapt to changing circumstances.